Welcome to another FAR walkthrough video. I'm Logan, and in today's video, we're going to be going over preparing an income statement. And we're going to be doing that the SuperfastCPA CPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour webinar training. We teach the key ingredients to passing the CPA exam, and again, it is only 1 hour and it is free. We will show you how to be effective and efficient with your studying. So make sure you go watch that. The link will be in the description. Also, just letting you know, we will only be going over 6 questions in this video, whereas Superfast CPA members will have access to the full 12-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. With all that said, let's dive straight into the questions. All right, here we are at question 1. Let's go ahead and dive into it. Which of the following statements correctly describe the differences between a single-step income statement and a multi-step income statement? So, before we get into the calculation stuff, I just wanted to point out that there are 2 kinds of income statements that you might see on the CPA exam. More likely, you're going to see a multi-step income statement. This is the more common thing that you probably deal with if you deal with this kind of thing in your work. But there are single-step income statements. So I wanted to make sure you knew the difference between the two before we dive into the multi-step income statement calculations. So if you don't know the difference, that's okay. Let's dive straight into the answer to learn the difference. All right, here is the answer. The answer is A. A single-step income statement combines all revenues and all expenses into single categories, while a multi-step income statement separates operating and non-operating activities, providing more details on gross profit, operating income, and net income. And so again, it says it here, a single-step income statement combines all the revenues and it combines all the expenses and then nets those together, whereas a multi-step income statement separates it out. It separates it into those operating activities, the non-operating activities, and some other things, and we're going to dive into those in the following questions. But again, single-step income statement, basically you total all the revenue together so that it's just one line, total revenue, and then you total all the expenses together so that it's one line and it's total expenses, and then you get the net income from that. Very simple. Again, you probably won't see this very frequently, but it is something you might see in the CPA exam. But the majority of this video, we're going to be going over a multi-step income statement. So let's go ahead and go to that. All right, here we are at question 2. Given the following information for Maplewood Corporation for the year ended December 31st, determine the total general and administrative expenses. Okay, so again, this is a multi-step income statement, but it's asking us to determine what the total general and administrative expenses are. You know, you might not know what that means. What's the difference between that and other expenses? If you don't know, that's okay. If you do have an idea, go ahead and pause the video and see if you can do the calculation. If not, let's go ahead and dive into this together to start learning what these are. Okay, the answer was $161,000. So again, if you didn't know much about this, we're going to explain it all right here. So first off, general and administrative, or G&A, expenses are the costs associated with the general operation of a business that are not directly tied to a specific function, such as manufacturing, production, or sales. These expenses are necessary for the overall administration and management of the company. Here are some of the examples. So in this next paragraph here, salaries and wages for executive management, like big officers, executive officers, administrative staff, and office personnel, rent and utilities for office space, depreciation of office equipment and furniture, office supplies, general liability and health insurance, and again, the key there is general, professional fees for legal, accounting, and consulting services, technology and communication costs such as IT services, software, telephone and internet, travel and entertainment expenses for administrative purposes, and miscellaneous expenses like office maintenance, repairs, and subscriptions to professional journals and industry associations. Again, a lot of this has to do with like the office, like the general people who are kind of just helping the company generally run without being a part of something very specific like sales. So with that knowledge, now we can go to these expenses and figure out what the total general and administrative expenses were. So the salaries, 30% of the salaries were for administrative staff. So that means that 30% of $180,000, that's $54,000. Then there was the depreciation expense for office equipment. Again, this was equipment that's being used in the office generally, $20,000. Utilities expense, rent expense for office space, they use 70% of the office space for administrative purposes or general purposes. So that means $42,000 of the $60,000 is for general and administrative expenses. Supplies expense, and this was for office supplies, that's $5,000. Insurance expense, again, general liability, so just in general for the company, that's $15,000. Now, when it comes to advertising expense, this is not considered a general and administrative expense. This is actually considered a selling expense. And then there's interest expense. This is also not considered a general and administrative expense. A lot of times this might be considered non-operating or different things like that. We're going to talk about those things in just a little bit here. But total, all of the general and administrative expenses add up to be $161,000 in this case. The big thing to remember is that general and administrative expenses are just the expenses in general for the corporation. They're not for any specific group in the organization. They're not for any specific reason like selling or anything like that. They're just the general expenses that you need to run the company. So with that, let's go to the next question. All right, here we are at question 3. Given the following information for Oakwood Enterprises for the year ended December 31st, calculate the operating income. So what is operating income? Hopefully you know what this is if you've been in accounting for your schooling or for your job, but if not, that's okay. Just remember that there are certain things that go into operating income and other things that don't go into it. And again, this is all for a multi-step income statement, which is the thing that you're probably the most familiar with seeing. So if you want, go ahead and pause the video if you know how to do this. If not, let's go ahead and dive into the answer. All right, here's the answer, $310,000. So let's talk about operating income. To calculate the operating income, we need to focus only on the revenues and expenses that are related to the company's primary operations. This includes sales revenue, cost of goods sold, selling expenses, and administrative expenses. Non-operating items like interest expense, gains or losses on sales of equipment, income tax expense, and gains on investments are not included in the calculation of operating income. So as it said here again, it's for the company's primary operations. So we take the sales revenue less the COGS, the cost of goods sold, and that gives you the gross profit, and that equals $400,000 in this case. And then you take the operating expenses, which in this case is the selling expenses plus the administrative expenses, and that gives you $90,000 of operating expenses. So you subtract those from the gross profit, and that gives you the operating income. And by the 6th question, we'll kind of show you how this all fits together in the calculation of the income statement and kind of what it would look like on an income statement. But this is one of the first things you do on an income statement is figure out the operating income. And then from operating income, you calculate other things. So with that said, let's go ahead and go to the next question. Okay, here we are at question 4. Given the following information for Elmwood Inc. for the year ended December 31st, calculate the total non-operating income. Okay, so we talked about operating income in the previous question. Now we're talking about non-operating income. You'll notice that there are some different things here. So which of these is a non-operating item? Again, we just talked about the operating stuff, so hopefully you can kind of pick out the things that were in the operating section. So what is now in the non-operating section? Let's go ahead and have you pause the video, see if you can get the calculation correct yourself, and when you're ready, come back, we'll look at it together. All right, and the answer is A, $24,000. So let's go through this. To calculate the total non-operating income, we need to consider revenues and expenses that are not related to the company's primary operations. And again, we talked about the stuff that is related to that in the previous question. So for non-operating, these typically include interest revenue, interest expense, gains and losses on sales of investments or equipment, and dividend revenue. Selling expenses, administrative expenses, and income tax expense are not part of non-operating activities. So we add up all those things together, the interest revenue, subtract the interest expense, add the gain on the sale of investments, subtract the loss on the sale of equipment, and add the dividend revenue. All together, that equals $24,000 of non-operating income. And with those two things together, the operating income and the non-operating income, that's typically what we would call the income from continuing operations. You know, the business that's going to continue to function for the next while. So with that said, let's go to the next question where we're going to talk about discontinued operations. All right, here we are at question 5. Given the following information for Pinewood Corporation for the year ended December 31st, calculate the total impact of discontinued operations on the net income. So we have the income from continuing operations before tax. So again, this would be the income that we just calculated from the operating income and the non-operating income. These are the things that we've just calculated, and we haven't calculated tax on those. But then we do also have a loss from discontinued operations before tax, and we have a gain on disposal of those discontinued operations before tax as well. The income tax rate is 30%, but how does this all affect the income statement? How does this affect the net income? So if you don't know, that's okay. If you do, go ahead and try to pause the video and do the question yourself. And once you're done with that, let's go ahead and look at it together. Okay, the answer is $10,500 decrease to the net income. So let's go through this as well. To calculate the total impact of discontinued operations on net income, we need to account for the tax effects on the loss from discontinued operations and the gain on disposal of discontinued operations. So we have to figure out the taxes and the tax effect for these discontinued operations before we do anything else. So we have to net these two together, to figure out what the net loss is from the discontinued operations, and that's a $15,000 loss. Then we multiply it by the tax rate of 30%, and that means that there's a $4,500 tax benefit that we add back to this loss. So the loss actually only ends up being $10,500, and that's the answer right there. But just letting you know how that fits in, before doing this, we would have had the continuing operations, and we would tax the continuing operations, and then we would subtract or add whatever happened. And you'll see that in the next question, in question 6, we're going to do all of this together. But overall, the total impact of discontinued operations on net income is calculated by subtracting the after-tax effects of both the loss from discontinued operations, if there's only a loss, or also if there was also a gain of some kind, the gain on the disposal of discontinued operations. The tax effects must be considered to determine the true impact on net income. So one last time, this is the last thing you consider before you actually get your net income. So let's go ahead and go to the next question to kind of put all of this together so you can see it working together. Okay, here we are at question 6. A company's activities for the year included the following. They had gross sales of $5 million, they had cost of sales of $1,800,000, they had administrative and selling expenses of $900,000, they had a correction of an overstatement of prior year depreciation of $50,000, sales returns $80,000, gain on sale of marketable securities $15,000, gain on sale of discontinued division $6,000, and an unrealized loss on available for sale securities for $4,000. So the company had a 25% effective income tax rate. What is the company's net income for the year? So we just went through all of this, and if you're having a hard time picturing how it all fits together, that's totally okay. It's kind of hard to do that with one little multiple choice question at a time. But if you kind of know how to do this, that's great. Pause the video. If not, we're going to go through this all together so that you can see how this all fits together on an income statement. Let's go to the answer. All right, here's the answer. The answer is A, $1,680,750. Now again, it might have been hard to picture how all this fit together, so we're going to put it all together here. This is kind of a mock income statement. I know it's not perfect, but I just kind of wanted to show you how each step worked. So first, you start by calculating the net sales. Net sales is the gross sales less any sales returns, so that gives us $4,920,000 of net sales. Then we subtract the cost of sales. Again, this is basically cost of goods sold. That gives you the gross profit, which in this case is that $4,920,000 of net sales less the cost of goods sold, equaling $3,120,000. Now from that point, this is when we start calculating the operating income. So we take the gross profit, subtract the administrative and selling expenses, and we talked about those before, and that equals $2,220,000. And again, that gives us the operating income. Now, to get the income from continuing operations, we would add any non-operating income, which in this case was the gain on the sale of marketable securities. So as you can see, it doesn't really say it explicitly here, but the operating income plus the non-operating income equals the income from continuing operations, and total that equals $2,235,000 here. Now, before we consider the discontinued operations, we then consider the income tax expense for this continuing operations. So we multiply it by 25%, which was the tax rate in this question. So we have a $558,750 tax. We subtract that from the income before discontinued operations, equaling $1,676,250. Now we start thinking about the discontinued operations. We take the gain from the sale of the discontinued division, multiply that by its tax, or basically you multiply it by 1 less the tax rate, and that gives you the amount of the discontinued operations that is considered income. So we add that to the income before discontinued operations, and that gives us a total net income, which again is the income from continued operations, which was all of this calculated up here, and then we add the income or loss, but the income in this case from the discontinued operations, giving us $1,680,750 of net income. Now you might have noticed some things we're missing there. Unrealized gains and losses are recorded on the statement of other comprehensive income, and that's something that we're going to talk about in another video. And any prior period adjustment, like the depreciation expense that it mentioned, are or is reflected in retained earnings, not here on the income statement. So I know that was a lot. This one was kind of an amalgamation or a mixture of all the other questions smushed into one so you could see what doing a full income statement kind of looks like. Again, I know this doesn't necessarily look like an income statement, but I wanted to show each calculation as it went, and that's how you calculate the net income on an income statement. We are going to talk about adjustments and things like that in another video, but in this one we were just talking about preparing the income statement. Now with that, we've learned a lot in just 6 questions about how to prepare an income statement. So before we go any further, let's do one more part of the process called pillar topics. Now the idea behind pillar topics with SuperfastCPA CPA is as you're going through the questions to learn the material, you will notice things that keep popping up, the types of equations that you've seen multiple times. You've seen gross profit a whole bunch. You've seen how to calculate operating income a whole bunch of times. These are the things that keep popping up. There's a lot of questions about them in your review course. So you make a pillar topic on each of these so that you know them for later and you can remember them. With that said, let's look at the pillar topics for this video. So here are the pillar topics. Again, these are the things that I felt were most important or that stuck out the most that you need to know or that I would need to know for the exam. So operating income, remember, equals gross profit less the total operating expenses, and operating expenses include selling and administrative expenses, and we talked a little bit about those. Non-operating income includes revenues and expenses not related to the core business operations, such as interest income, interest expense, and gains or losses on sales of investments or assets. Now, the effect of discontinued operations on net income is determined by adding the after-tax gain or loss from discontinued operations to the income before discontinued operations. So again, you have to do all the calculation for continued operations before you consider the discontinued operations. And one more thing that would be good to know would be gross profit. Remember that gross profit equals net sales, which by the way is total sales less sales returns or discounts, less COGS. So net sales less COGS equals gross profit. And then finally, we didn't really talk too much about this because again, you're mostly going to be focusing on a multi-step income statement, but just in case, remember that a single-step income statement combines all revenues and all expenses into single categories to calculate net income, while a multi-step income statement that we've been talking about separates operating and non-operating activities, considers discontinued operations, providing more detailed information on gross profit, operating income, and net income. And with that, those are the pillar topics. Thanks for watching. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, we will teach you the key ingredients to passing the CPA exam and how to be effective and efficient with your studying so you don't waste months or even years of your time trying to pass this exam. Also, just remember that while we only went over 6 questions in this video, Superfast CPA members will have access to the full 12-question video when we post it in the members forum. So if you like this, you can get more of it by becoming a Superfast CPA member. If you like the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.